Hi, good afternoon, everyone, and welcome to Stonehearth Capital Management's quarterly update webinar series, CIO's Corner, with our Chief Investment Officer, Chris Gauthier. I'm Amanda Sylvia, and I am the Client Service Associate for SCM. I'm so happy to be assisting Chris today. I do want to start off with a few housekeeping items. Please use the Q&A button at the bottom of your Zoom window to submit any questions you may have throughout the course of the webinar. I will ask Chris to answer as many as he can at the end of the webinar. But if we do happen to run low on time and do not get to your question, Chris or myself will reach out to you directly at the end of the webinar just to make sure we get your questions answered. I'm so excited to introduce our speaker. Chris Gauthier is Stonehearth's Chief Investment Officer. He brings with him more than 20 years of investment management experience to our firm, working with both institutional and individual investors. He is responsible for setting our firm's overall investment policy and strategy, including directing our asset allocation, investment risk, research, and portfolio management functions. Chris, thank you so much for speaking with us today.
Thank you, Amanda, and good afternoon, everyone, and thank you for joining us today. Hope everyone is enjoying a healthy and happy start to the new year. I know in at least New England, we've been very nice weather. Snow was held off for most of the time, which has been good. So with that, let's jump right into what we're going to cover today. We've got a lot to go over. A little technical difficulties. There we go. Got the slides working now. We're using Zoom for the first time in this webinar, so it's a learning experience for both Amanda and myself hosting Zoom on a webinar, but it's been great so far. So as always, what we'll cover today, we review recent financial market performance. And as 2022 was definitely a year to forget in the capital markets, as we'll see. We'll also take a look at the current investment environment through our multiple lens framework using technical valuations and economic data. And as we will see, is really stuck in the middle. Not a great, but not horrible either. We'll look at how we are positioning client portfolios in this trendless, choppy, muddle through environment we're seeing. It definitely won't be this way forever. And when it breaks one way or the other, the move should be very significant. And finally, like Amanda said, we'll leave a few minutes to answer any questions you may have. I always like to start with the next chart, which is our investment philosophy. I think more firms should do this when they have any type of webinars, because it really provides a nice framework for the discussion and really helps shed light on your thought process and leads to a much fuller understanding of some of the conclusions we come to. So for those of you who have been on this webinar before, we believe in mean reversion. Trees don't grow to the sky. Data tends to oscillate around the mean. You never stop at average, but you go up and down below the mean traveling. Valuation matters, right? It's probably the biggest driver of investment returns over the long term, what you pay for something. Core factors provide excess returns over and above the indices. Diversification, still only free lunch that we see in investments. And risk is not stationary, right? It fluctuates throughout the market cycle, and it must be adjusted for in client portfolios. So with that, let's start, as we always do, with the historical performance of asset classes. Surprisingly strong quarter to end a really, really bad year. Risk assets led the way higher, with international markets represented in the green bars, finally showing some strength versus the U.S. equity market in those light blue bars. You can see that EFA, think Europe, England, Japan, were really the leaders in the quarter, up almost 17%, followed by the Dow Jones, the U.S. industry, almost up 16%. Large cap growth and tech, those old FAMAGA stocks, Facebook/Meta now, Apple, Amazon, Netflix, Google, those stocks really continue to struggle in the quarter, falling 12 basis points. You can see that that's represented by this NASDAQ index here because they have a high weighting in that. So it did not really perform well. We continue to see a very high correlation between bonds and stocks. Now, bonds are represented in purple here, and credit led the way in fixed incomes. Think about corporates and high yields compared to treasuries, and we're mostly higher in the quarter. The one outlier in fixed income world is long-term treasuries, down almost 2%, and it just capped off a terrible year for treasuries, as we'll see in our next slide. Nice performance from commodities. We saw oil up almost 7.5%. Commodities in general, which when you add to oil, you add food and agriculture, was up 2.5%. Definitely doesn't help consumers and definitely doesn't help on the inflation front, which we'll take a look at later in the presentation, but good in terms of financial performance for people invested in that space. The worst performing asset class was the dollar, down 7%. So that falling dollar definitely had some help on overseas markets, because as the dollar falls, international markets tend to have better performance when priced back in US dollars. It's just an accounting thing, but it does matter to when you hold international assets in US dollar. So closing out, definitely a quarter we will take, but it doesn't look as good if we look at 2022 in its entirety. The same colors apply here, but in 2022, stock bond correlations, they turned positive and really left traditional investors with nowhere to hide. Volatility spiked, and as you can see from this chart here, prices just plunged almost across the board, with only in yellow, which is commodities, that oil and the dollar, the only positives. There was some downside protection that we had in the short end of the curve, represented by that short-term treasury down 3.88, or floating rate bonds, which tend to have better performance when rates rise at 5.3, and the Dow provided a little bit of protection at 7. But it's all relative. They were all down, really just not as much as the rest of the financial universe. Fixed income, again, represented in purple, also struggled in the year, and it was one for the record books, as we'll see in a moment. If you look at the book all the way over to the right, two asset classes that usually aren't mentioned in the same breath, unless they were the opposite, is the NASDAQ and long-term treasuries. Again, NASDAQ tends to be that for MAGA stocks, not lumped together, because the worst performance in 2022, and usually you see them have negative correlations, not these positive correlations. And we look at the worst performer, NASDAQ down 32, S&P was down almost 18, a little bit over 18% too. With that rally we saw in international stocks in the fourth quarter, we saw some stronger relative performance in the international, which is one reason we like that a little bit better than the US from a valuation perspective in portfolio. Before we leave 2022 behind, I thought a few more, and I really apologize for this, painful slides might be helpful in showing just how much of an outlier the year really was. So we're looking at the Bloomberg aggregate, which is like the S&P 500 of the bond world, right? It's a broad-based index tracking a whole bunch of US bonds. We have data going back to 1976, which is the inception of the index. And since then, 90% of the time, look at 47 years of data, 90% of the time it was positive. And we look at what happened in 2022, over way on the right here, you can see it was negative. So that's a shocker, right? Because it's only about 10% over the time frame down markets, but just the magnitude of the loss. It was the worst bond market we've seen since the inception of this indices. Not only goes back to 76, doesn't include the Great Depression, which I'm sure was really bad, but in terms of this data, you can just see how bad it was in the fixed income world. And it looks even worse from an investor standpoint when you add in stocks, because usually bonds and stocks trade differently. As you can see from this chart right here, we're looking at the S&P 500 for the stock representation on the x-axis, that ag on the y-axis, and plotting the performance of each and all these given years. You can see that most of the time, they're mostly positive, or they're mostly positive and negative. They don't trade negatively together. That's this lower left-hand quadrant. Over here, except for a few occasions, and especially in 2022, you get one of the worst returns ever for diversified portfolios since bonds fell as well as stocks, which does not happen that often. So again, felt a little worse for investors. And the poor performance we're seeing was just not concentrated in these two markets. It wasn't like just the US bond market and just the US stock market went down. We're seeing poor performance across the board. When you see on the next slide, we're looking at 112 different mutual fund categories classified by Morningstar. And we look on the right-hand side over here, fully 94% of them posted negative returns. We haven't seen anything that bad since the great financial crisis of 2008. Again, 105 out of 112 asset classes were negative. There really was no place to hide in 2022. So with that, I think we just say goodbye, good riddance to 2022, and move on to hopefully brighter days ahead. So we'll turn back from the past and see what the present environment is telling us from an economic, valuation, and technical picture. So this continues to be the most important data point, same thing I said last quarter, out there. It's having the most influence on asset prices across the board. And we don't really expect this dynamic to change anytime soon. So what we're looking here is the Fed funds rate. And when you look at this dark gray line here, that's the actual Fed funds rate. So you can see that right here, we're at 4.38. Now, what the Fed does, it doesn't have a single point, it has a range. So the range right now is 425 to 450, so that's where you get that 438. Fine. So that's good. Everybody kind of gets that. That's where the Fed is. We have a Fed meeting tomorrow. So I'll probably see this going up. And that's what this blue line is FOMC, which is the Federal Open Market Committee. That's their expectations for interest rates. They control them, right? This is what they're saying we're going to do. They're telling you what we're going to do. And what I want to point out here, and this disconnect between the Fed and the marketplace, is the marketplace is green. So what the market's saying is, we don't believe you. You're not raising the rates, right? And then you have, as an investor, who do you believe? And how is this resolved? Will go a long way in determining how 2023 plays out. So again, you hear a lot, don't fight the Fed. Right now, the market is fighting the Fed because it does not believe they're going to raise rates, and they believe the Fed's going to pivot very soon. I'm not so sure that's the case, and we'll kind of go through the evidence that backs up that. But we also want to look at the market expectation, that green line. So this is that green line we're looking at. We're looking at upcoming Fed meetings, right? So they have one tomorrow. And they have one in March, take April off. I guess they go on spring break. Then they've May, June, you can see it. And what we want to concentrate on here is these these light blue numbers. So these are the highest probabilities of what's going to happen on market expectations on that date. So on 2/1, which is tomorrow, a fully 98% of the market thinks the Fed's going to raise 25 basis points. I'm on board. I get that. The next meeting, 84% of investors think the Fed's going to raise 25 basis points. We're on board. Next two meetings, we get that. Then it starts to get a little bit interesting, and then really interesting around the end of the year. And this is where the disconnect comes. So the Fed's saying we're not lowering rates, and the market's expecting rate cuts at the end of the year. So history shows it's really not wise to fight the Fed, and we lean towards the higher for longer Fed forecast of rates based on the weight of the evidence. And the first data we're going to look at is previous hiking cycles, right? Just let's see what's happened in the past. We've had 8 previous hiking cycles, and they have all ended with the Fed funds, which is that blue line, above CPI. And CPI is just a measure of inflation, consumer price index. And you can see, looking at the current levels over here on the right-hand side, with the Fed funds at 4.5 and inflation at 7.1, we have a long way to go. It's tough to see how a Fed cuts into that. When I look previous ones, 1984, 11.8, 4.2, 9.8, 4.7, always higher. 100% accuracy that the Fed funds have always been higher than CPI when they've stopped raising rates. So again, this provides support that they have a long way to go. So again, inflation could come down. So when we look at the Fed and what their mandate is, they have a dual mandate. They have stable prices, which they've defined as average inflation of around 2% and full employment. So when we look at one end of that, the inflation, we see it's definitely improving on the left-hand side. You can see the peak probably happened in the summer at 9.1, and we definitely see improvement coming down to the current reading in November of 7.1%. Again, still a long way to go to get to that 2. And when you look at the components of inflation, which is by colors up here, you can see green is energy, used vehicles are red. You can see that's really the improvement has been coming. Why? It's easy. It's low-hanging fruit, right? The Fed can hurt that demand. The stickier parts of inflation, which are these darker colors down here, shelter, restaurants, hotels, transportation, tend to be stickier, and the Fed has less control. Even if you reduced everything, you're still up at 5% there. So again, we think the Fed, while definitely having impact on inflation by making it lower, may not be able to get to that 2% average. And you can see on the right-hand chart, really from all inflation measures, just how far away they are. So we looked at Michigan's year inflation expectations, what investors think, right? So the current's at 5, down 2.6. CPI we've talked about. Core, which takes out energy, because energy tends to be volatile, still expectations up at 6, and they want it down to 2. PCE and trimmed mean PCE is just more sophisticated ways of measuring prices. We're not going to go into technicalities, but again, quick glance, they're way far away from being down where the Fed wants them. So again, looking at inflation, we have a long way to go with rates. So that's the first piece of it. The second piece of the mandate is employment. So how is the employment picture looking? This provides further support for higher for longer. These are forward-looking, right? We're not looking at jobs created, which tend to look in the rearview mirror. The one on the left-hand chart is job openings to job seekers. So how many job openings are there for people looking for a job? Definitely see it coming down off its highs, but again, elevated throughout history. So if you want to get a job, there is probably a job out there for you if you're willing to take it. So again, a lot of jobs out there, and we can see that confirmed by the quits data, which is up here on the right. So just think about it. Do you quit a job when there's when the chances are increasing that you won't get a job? No, you quit a job when you're fairly confident that you're going to be able to get another job, or you've been offered another job, which means that there's a lot of job openings up there. So again, like we're seeing in the first data point, coming down off its highs, but still way above where it is and showing a healthy market. And lastly, in the bottom right, we're looking at jolt layoffs. And again, layoffs are getting a whole bunch of press lately. I'm sure you heard about Amazon laying off, Microsoft laying off, Facebook/Meta's laying off. A lot of people like to scare people and they like the noise of that. But when we look at the actual data, the entire economy in aggregate, layoffs are still pretty tame. Now there is room to rise, and this could be the start of a trend. We can see this rise. But for now, what we're looking at is a very, very healthy labor market. And when we see a very healthy labor market, it's really tough to see a major slowdown in this data, and tough to see how the Fed starts pivoting and lowering rates into this. Because again, jobs, more money, tend to raise inflation numbers. So another way to look at the economy is we always think about GDP, right? Gross domestic product. How much is the economy growing? When we think of GDP, we want to think about the consumer, right? The consumer makes up 70% of the GDP. So with consumption making up 70% of the GDP here in the US, taking the pulse of the consumer, provides some good insight into the health of future of the economy. And what we're looking at here is different data points and how we look at the consumer here at Stonehearth, not all the ways, but a few major ways. To me, the first chart up top in red is average hourly earnings growth, right? Year over year, are earnings growing or are they shrinking? And you can see at 4.59, it's very healthy, especially compared to history. Now it's not keeping up with inflation, so it's not 100% bullish, but what we're seeing is that earnings are growing. Which is good for the economy, good for people, not so good for inflation, because the more money in people's pocket creates more demand, and inflation rises. Again, lays credence to the fact that the Fed will have to keep rates higher. And to me, the most important chart, I think, is the next one. It's a big, long name. This is just a percent of consumers' income that go to paying down debts, right? We all have debts. We all know what it means to pay down debts. This is how much of your monthly paycheck, weekly paycheck, you use to pay down debts. Right now, it's at 9.75. Doesn't mean anything. When we start looking at history, you can see that compared to history, it's fairly low. So what does that mean? It means that consumers are not overburdened by their debts yet, right? So they can make their debt payments. They can have capacity to borrow more. It's not like we saw in 2008 when they're up at almost 13, 14% and they had trouble paying their debts. Now, we don't see that. Now, definitely coming off the lows. So again, they are taking on more debt. We feel that it's a good thing when they have this much capacity. At some point, it becomes a bad thing and we reach that tipping point. But for now, given where they stand, there's no overburdensome on the consumer in terms of debt repayments. The next chart looking at is gas. I always show this in a investment committee meeting. I think it's a great way to judge consumer, and it has a real impact on that consumer sentiment data we're seeing on the lower chart here in green. And it's just something we see every week as a consumer, some of us twice a week, and we can judge it, right? It's a frame of reference for our prices getting higher. How's my budget doing, right? It's a very easy mental break the brains can take to say, okay, I can see it based on gas. And I know I feel much differently when I see 2.99 for gas compared to I see $4 for gas. It makes me feel a little bit better about my own financial situation. And you can see that gas is high, but it's coming down off its highs. So again, that is helping a lot of that consumer sentiment on the bottom. Again, coming off the lows, but showing that a consumer is feeling much more confident about the future, which lets them invest and buy and consume, which helps the economy since it's 70% of the economy. So like we're seeing in most of the data, the consumer, not great, because it's still taking on excess debt, wages not keeping up with inflation, but not horrible. And when we look at the data, horrible, maybe okay. I mean, not horrible, just okay, maybe okay, right? Maybe good enough to avoid a deep, painful recession. Another way to look at the economy is the housing market. It does have an outsized impact on the economy because it generates a lot of transactions. And really, not to sound like a broken record, I apologize. The weight of the evidence is okay. And the one thing that really keeps me positive on the housing market is this top chart, and they don't talk about it enough. And this is a single family homes month supply. This is just how many homes are out there, right, available. And you can see that going back in time, we have an average of 6.49. So we've undersupplied compared to history. So we need to create more housing. So again, doesn't mean that we're going to be building houses like crazy. No, but it means there's a floor in the market, and we're not going to experience 2008 or something, a real big crash based on that data, because we need to build houses. One thing not helping the housing market, I'm sure we're all aware of this, is the mortgage rate up at 6%. And you think about a year ago, it was almost half that at 3%. It's starting to flatline now, which gives me confidence. And remember, we adjust to things, right? This is just recency bias. It wasn't 3% a few years ago, right? It was up at 6%, 7% in the 90s. We have seen higher rates. And again, markets adjust, right? If it's not spiking up, it's not creating shocks in the marketplace, then we adjust. We realize that 6% is fine. Housing prices come down a little bit, make it more affordable, even at the new 6% rate, and life moves on. So again, as long as we don't see spikes, we think these higher mortgage rates are manageable in the housing market. Again, but it is causing an impact. We do see the housing starts, which is the next chart, coming down a little bit, and we can see a leveling off in the home price index. So again, remember, markets price in the future. And, when looking at we're not priced for a deep, long-lasting recession, they seem to have priced in a little shallow, short recession, which is supported by the data we just went through, just the okay economic data. The data we just looked at would really have to get much worse, start really falling off a cliff to provide support for that deep recession call. Just not seeing it yet. But as we mentioned, when we looked at the Fed, they are in control of the markets. Any mistake they make, any at all, either easing too quickly or tightening too fast, could overwhelm all the data we just looked at. So it really does provide support for that heightened level of risk in the markets we're seeing. Now, what is not wavering, what is shouting recession loud and clear from the mountaintop is the inverted yield curves we're seeing. What we're looking at here is two pieces of the yield curve, right? The 10s and 2s. So we're looking at what a 10-year Treasury bond yields compared to what a 2-year Treasury bond yields. We're also looking at that same 10-year against a 3, so longer versus short. In a normal functioning market, like we've seen throughout history here, it should be positive. Makes sense. If you lend money for longer, you need a higher rate. But there are certain times throughout history, and it's happened 7 times, when that's not the case. And they call it a yield curve inversion. And the question you ask is, why does this matter? Well, the first thing, it usually means that something's wrong with the economy, right? Because it's not a normal state. But we also look at those 7 times in history. So when the 10s and 2s, which is that purple line, right here, invert, 86% of the time, within 13 months, there was a recession. Even more compelling is use the 10 and 3-month Treasury, which is represented by that orange line. 100% of the time, in 9 months, there's a recession. All right, so just look at the historical data. This doesn't mean this isn't the cause of the recession. You think about when you have a cold and you have a fever. The fever is not sickness; it's just indicating that something's wrong. And prior history says that we should be heading to a recession fairly soon, based on the inversion of the yield curve. Some other economic data is pointing to a potential recession too. When we look at companies, we're looking at the PMI indices. We use services in blue, and we also use manufacturing in orange, pretty self-explanatory parts of the economy. We like to use these indices as the judge of future economic activity because they're what we call diffusion indices. What does that mean? Well, what it is, the corporation who produces these indices is calling up multiple corporations across the economy and saying, on different data points, is it getting better, staying the same, or getting worse? So imagine they get a call and say, hey, is your labor, is your hiring, potential hiring getting better, staying the same, getting worse? Add all that up, and what it means is above 50, you show an economy expanding. Below 50, you see an economy contraction. So you can see the weakness in this data really pointing to a contracting economy. It doesn't point to the level of contraction, which is important, as we'll talk about in a little bit later, but it does point to a potential recession ahead in the data. So taking the whole economic data, companies and consumers and everything we're seeing, it really is supporting a slowdown in economic activity, but not a deep recessionary contraction yet. And we will see how this factors into our portfolio construction and asset allocation at the end of this presentation, when we take a little bit closer look at this data and our risk models. So with that, let's leave the economy. Staying in the current economic environment, let's turn to the equity market. And like the economic data, just okay, or average based on history. In fact, it's almost right on average. So this line here is looking at the PE ratio of the S&P 500 index. PE ratio is just the price of the index, all the constituents added up, what's their price, and their earnings, how much money they make. So it tells you how much you're paying for $1 of earnings. The takeaway is when it's elevated, it's expensive. When it's lower, it's cheap. And we see it's right there sitting on average. And we know from our investment philosophy page at the beginning of this presentation, we don't believe in average, right? We believe in mean reversion. Things go around the mean, and history proves that out, right? It very often does not stay on average, see the above or below. The best thing you can say right now is that it's not as overvalued as it was, which we saw over here when it was 22 times. Very recently, before COVID, it's gotten much better. But really strong bull markets really do begin at cheap valuation levels. Think down here. So again, it may imply there's a little bit more downside left in this marketplace. And again, it's just not the PE. We have multiple ways to look at valuation. Look at the CAPE, which is our preferred measure. It just takes out inflation and looks over 10 years. Again, right on average. Dividend yield, if you use in our modeling, right pretty much on average. So again, everything's right on average. One other way to cure this would be earnings, right? So earnings is the denominator. If earnings increased, that would help lower this PE ratio. But the data we're seeing at the earnings doesn't look like there'll be much help from the valuation picture, because you see the growth of equity earnings in the S&P 500, which is that deep blue line, but also EFA, emerging markets, and small cap. You can see that growth has been coming down. And what even more important to us that we look at is the right-hand chart over here. It's EPS revisions. What is EPS revisions? It's earnings per share. And all it does is it takes how many companies are getting upgraded to the earnings estimates and how many companies are getting downgraded. When that's over 1, you can say analysts are getting more bullish and increasing earnings in general. When it's below 1, it's decreasing earnings and becoming more bearish. And pretty simply look at the chart, you can see how bearish it is and how bearish it's getting. So again, this really estimates what earnings are going to be, and it doesn't provide a rosy picture. So we could be in some further downside in the market in the long run, as fundamentals do drive long-term performance. So it's something we're watching closely, and we're in the middle of earnings seasons right now. So see how that plays out. But before we leave equity land, we really want to move, before we leave equity land, go to fixed income, we want to take a look at the technical picture of the S&P 500 as of year end. So looking at the daily close of the S&P 500, which is this red and black line. We also threw in the 50-day moving average, which is that blue line. The red line is a 200-day moving average. And that gives you a great picture of what's going on in the market. I mean, this is one of my best charts. Anytime you want to look at how anything's doing, any asset, you kind of pull up this chart. You can see that after the initial sell-off in this year, we kind of win this choppy, trendless market, using that 200-day moving average, which is the red here, as resistance. So we kind of run up to that, come back down, run up to it, come back down, run back up to it, come back down. So to us, that means that's resistance, right? We really want to see a breakthrough for that on the upside to get incrementally a lot more positive. Look at the top chart, which is the RSI. So again, this is where the trendless, chopless market comes in. I mean, look at the RSI up here. It's just a relative strength index. 70 oversold, which means too many people are selling. It's a good time to buy. Down here is a good time. It's a good time to sell when it's above 70, good time to buy when it's down here. Like we're seeing in the economic data, in the middle, right at 45, not giving us much information one way or the other. Another way we look at it is a MACD, and we see that this is kind of neutral too. It tends to be more positive when the black line goes through the red line on the upside, more negative on the downside. We're just kind of there. So from a technical standpoint, it does provide some support that we're not heading off a cliff, but really not giving you that impetus for a next bull market. How this defines itself is going a long way in trying to define how much risk is in the marketplace. We really want to see this 200-day break and firmly break above it, not like a little break above here, and stay above this before we get more bullish. So that kind of takes care of equity land. I'm going to move over to fixed income, and we're going to start with the yield curve, which we know is inverted in certain places from our previous slides. But not just individual points, but the shape of the curve can also be a good barometer of the current and expected economic environment. And what we're looking at here is the yield curve. So what's the yield curve? It's just what the U.S. Treasury has to pay to borrow at certain timeframes. If I'm a U.S. Treasury and I need to borrow, if I'm the U.S. government, I need to borrow money on 12/31/2022 for 3 months, I have to pay 4.4%. If I want to borrow money for 5 years from investors, I have to pay 4%. At 10 years, I have to pay 3.9 and so forth. So it just lines those up at different maturity dates. And when we look at this throughout history, a steep and up to the right, which means, longer rates are higher, that usually indicates future growth. And again, quick glance, we can see from this slide, the current shape is far from steep, right? And almost flat, indicating slower growth ahead as rates have to be cut due to slower growth is what this is saying. So again, another indicator, another thing we look at in terms of trying to get the environment, the bond market, at least the investors in the bond market are telling you they see slower growth ahead for the marketplace. Unlike what we're seeing in a lot in the equity market right now. So before we leave this, I just want to show you what's actually happening there. It's just amazing how much rates have moved. Look at this bottom pane, these dark blue. This is what the Fed has accomplished, right? So again, we looked at that poor fixed income performance, that record breaking. It's right here, and the Fed really controls this, but everything it gets impacted by what the Fed's doing, raising rates. And in this staid, old, boring bond market where 50 basis points or 0.5% is a huge move, we're talking 4 times that, right? 5 times that, 4% moves. It's absolutely amazing that more stuff hasn't broken yet in the marketplace, given just how far we've come. And there is no really historical precedent for this high rate rise. So that's the interest rate curve, that's treasuries. Another way to look at the economy and the bond market is perceived health of corporations. And here we're using credit spreads. So what's a credit spread? It's just the amount above that yield curve that we saw. So again, above the amount that we can lend to the US Treasury that banks are charging corporations to borrow money. So it's a good judge for how much risk is in the marketplace in the credit market. So again, when you see stress, when you see recessions, when you see bad things happening, you want to charge more for companies to borrow money. You don't want to charge less. And we look at 2 types of corporations: the US corporate, which is just, think Apple and those ExxonMobil, which is in the green line, and the high yield, which is the more riskier companies, and they have to pay more to borrow. You can see compared to history, they're not showing any signs of stress, right? It's still all right. It's about average. When we look over here, it can mean a 20-year average. It's, a little bit above certain pieces of the curve, but in general, overall, credit spreads are just average, right? So banks aren't charging excessive fees because they don't see a lot of stress in the markets. They think corporations pay their money back. They don't see a big, deep recession. So again, looking at the health of corporations and the economy from this angle, it looks good and it's showing no signs of stress, really indicating banks don't see any major issues on the horizon, and they usually are the first ones to see this. Last thing in fixed income, we talked a lot in negative about the Fed rate rise. We saw that in the performance, but it's not all bad. There is a bright side to this. One of the byproducts of the rate rise is more attractive potential income stream from fixed income. And we haven't seen this in a long time. So what we're looking at here is different fixed income instruments, US Treasuries on the left, munis, investment grade corporates, mortgage-backed securities, all the way over to high yields and leveraged loans, which is another word for floating rate, the 10-year range of income they provide. And you can see that, US Treasuries, 50 basis points up to 4.5% at one point in terms of the past 10 years. But on average, which is purple, you earned 1.5. Right now, thanks to the Fed, you can earn 4.2. And it's not just treasuries. Look at high yield, which is kind of the risky end of the marketplace. Before, you were getting 6%, which seems good, but again, inflation up at 9, not great. And they're very risky companies. You can now get 9% income stream. So again, if there's some default, if there's a little bit of wobble in the economy, you're being more than compensated by this, could be more than being compensated by this excess income. You're getting 9%. So again, we haven't seen these in a long time, and you might actually start getting a real return. And what a real return is an income stream above inflation from bonds, which really would be a nice treat for investors and savers. And we haven't seen that in a long while. So again, there are some positive from the rate rise. So let's put all this data together, and we're going to look at it through our multiple lens risk model, which uses a weight of the evidence approach to judge the level of risk in financial markets and really does help drive our asset allocation decisions. For those of us who joined us before, this would be a repeat, but if you're new to us, we use 2 models really to help us understand the current risk environment, to help with asset allocation, and to find the signal through the noise. One is an external from the folks at Ned Davis, which can be seen in this chart. It's called the Fab 5 composite. It's run by Ned Davis, the person, but he has a staff that runs this model and kind of takes a look at the risk environment from 4 different components. Those components are broken down into multiple indicators too, so you get a very robust model going back through time. You can see it's firmly in negative territory at -2 right here. And you can see going back through history, in the bottom charts, that when it's below 1.5, the S&P has not done well. Doesn't mean all the time. right? Doesn't mean every time it gets down there. It just means the probabilities line up. When we look at the weight of the evidence and we get a negative reading, it tends to lead to poor performance. So that's what he's saying. So again, firmly in negative territory, and really he's pointing to excessive risk in the markets. And, a defensive posture is warranted based on the Danvers risk model. We also use our own internal risk model that we've made as a complement to NDR. We do use 4 lenses to view the market. We use technical, valuation, macro, and qualitative. And our model, despite the rise in the markets we saw in the fourth quarter, really no change. It comes in at -7, same place we were last quarter when we spoke. Our model continues to confirm what the folks at NDR are seeing and point to a negative environment for taking excess risk. But as you would expect, given the strong fourth quarter performance, we did see slight improvement in our technical indicator, not so much in the structure, but you can see down here in the end, the technical reversion, we went from a -1 to a 1. And what reversion looks like, it looks for changes in the marketplace, entry and exit points, changes to market trend. So what that's indicating to us is that the potential for a change in market trend, which is a good sign, right? Because we've been heading downwards for 2022, has increased. It's not enough to overwhelm the negative piece we're getting from the structure of the market. Again, we look at the structure of the market, it's the number of stocks, breadth, participating, what parts are outperforming, not enough to overtake that. So when we look at it all together, right, with the technical picture is still not supportive for taking excess risk in portfolios, despite the improvement we saw in the quarter. The next thing we look at is valuation. We use 3 different indicators: CAPE, which we talked about before, dividend, which we saw on that chart too, and slope of earnings. So again, things that are really important to us. No change to the valuation indicator, as we're only working off the excesses of the past 15 years or so, and really have not moved into cheap territory yet, which we saw on that chart. And we're picking up that same thing in our indicator too. Getting closer, just not there yet. A good earnings season may help us, but so far it hasn't got there. Despite what we're seeing in the market price action, just earnings are coming in a little bit weaker than expected. So we're not seeing a lot of improvement on our valuation indicator yet. So again, still firmly in negative territory. We looked at the macroeconomic data, and again, you can see we do put that ISM in there, but we also use jobs, copper, new orders to kind of give a health of the economy. We did see weakness in the economic data, but not enough to tip the scales, right? So the weight of the economic evidence is still supportive for taking on risk. So while positive in the economic data, it does not offset the weight of the other evidence we're seeing, the negative data, the negative technicals, the negative valuation in other areas. The last piece of our model is a qualitative, and when we look at qualitative, it's anything that can't be captured quantitatively. It's just some things you can't capture in a math model, right? It's just out there. And when we look at the qualitative landscape right now, it really has a negative feel to it because of the Fed, right? The Fed keeps increasing rates, and there's a don't fight the Fed, and markets tend to do poorly when rates rise. So that leads to a negative environment. So adding it all up, everything together, really our 2 models are in harmony, right? And the overall weight of the evidence of our risk modeling is indicating a cautious stance in asset allocation, as we're seeing poor technical picture and elevated valuations, a hawkish Fed really outweighing that positive influence we're seeing from the macro environment. So let's put this all together and let's take a look at how the weight of the evidence translates to portfolio allocations. So we remain defensive in our asset allocation like we were last quarter, but not 100% bearish, and intend to remain patient given the current defensive positioning and the muted evidence, again, trying to find a signal to the noise available, really waiting for that stronger signal to emerge before acting. So we remain in red, underweight risk assets. We do favor international, a little bit over US, given the better valuation points and a little bit of relative performance we're seeing there. Do like small caps over large, especially in the US. We think they're a better valuation picture and provide more growth. And we lean towards traditional value stocks, away from those market cap indices, away from the NASDAQ, away from the S&P 500, companies that make things, produce cash, have good business models, and not just relying on cheap Fed money to deliver growth to investors. We do maintain our overweight to fixed income, but not traditional fixed income, not duration. We remain underweight. to traditional fixed income, with the overweight coming from our bond subs, right? Now, substitutes, flexible income products like floating rate and things like that. Products which are better positioned to weather an uptick in interest rates. And plus, now we see where the rates are now. If you stay near the short end of the curve, you're getting some pretty decent yields, about 4% for a year and a half, 2 years. So that's pretty good given what we're seeing in the risk environment. We do remain overweight to cash, short-term bonds. Again, using short-term bonds because you're getting a very nice pickup in yield for that. And that's just indicated by our risk model that we want some cash on the sidelines when opportunities present itself. And finally, we do maintain our underweight to our opportunistic bucket while we wait for better opportunities, but we do have some weight there. So there are some opportunities. We do like precious metals in certain flavors there. And we do also like clean energy because we think that is going to provide some nice pickup for investors as we look out to 2023. So final thoughts before we get to questions. Performance, nothing to say. Goodbye, good riddance to 2022. We're not going to bring it up again. Steve saw a disconnect between the Fed and investors, right? On the path and terminal value of rates, terminal just an ending value where they stop raising, have a huge impact on markets and how that plays out. And as you're probably aware, don't fight the Fed, right? Higher for longer than the market expects is our call on those rates. We're doing that by balancing the weakening macroeconomic data and the inverted yield curve with the perceived strength in the consumer and the not so bad housing market data we're seeing. Continued improvement in equity valuation front, no doubt, but far from inexpensive. Not seeing that fat pitch in valuations yet. One thing holding us back too is earnings revisions still negative, really not helping valuations. And the lower earnings are really a high potential risk as 2023 rolls on. There are some positives to have from rising rates we saw, right? You can actually get some income, high yield yielding 9%, even treasuries yielding over 4%. It's starting to look a little bit attractive again. We saw there's no signs of stress in lending markets, giving us a positive influence on the environment. In the quarter, we saw little movement in our risk models as the push and pull of individual components just really canceled each other out in the quarter. So bringing it all together, really the environment is just not that attractive for taking excess risk in client portfolios. Caution is warranted and wait for better days to arrive. So with that, I want to thank you all for listening to me for the presentation, compliance closures, and now I'll turn it back to Amanda to see if there's any questions out there.
Hi, Chris. Thank you so much. So just as a reminder to everybody, please use the Q&A button at the bottom of your Zoom window here. If you do have any questions while we go through some of these. Chris, I do have a couple just to get started. Why do you think 2022 was such an outlier?
Good question, the Fed. Yeah, well, I mean, 2022 was interesting, right? It's one of the most interesting times since I've been investing. Even compared to 2008, I thought it was more interesting. Even before then, you had the arrival of COVID, right? That's really had an impact. We shut down a global economy on a dime, right? We didn't have much precedent, right? It wasn't something we could go back in history and say, how do we do this? We didn't have a lot to go on, even including the Fed and policymakers. So we're kind of really learning on the fly, reacting to each individual data point, and rather than really anticipating. So I think we're still working through a lot of the impact of COVID, including supply chains, different workplaces, different consumer demand shifts. So there's just so much increased uncertainty out there. There's bound to be unintended, unforeseeable consequences, including the really poor financial market performance with the Fed raising rates. To me, it's just really what happens when we live through this great monetary experiment. And it is an experiment. We haven't done this before. We don't know the ramifications of what we're doing here. We're kind of doing this on the fly. And unfortunately, sometimes you break things, and that's what we got in 2022.
The next question, Chris, is, are you concerned about the debt ceiling at all? You didn't mention it in your presentation. So what happens when we default?
Yeah, well, we haven't defaulted yet, and we're highly unlikely to in the future, but I get it. We hear a lot in the press about this lately. We had a lot of clients calling about this too. I had a big debate about putting it in here. It's really like a high probability, low probability, high impact event from our standpoint. So taking a step back, and for those of you who don't know, the US, this so-called debt ceiling, it's self-imposed, right? We put it into law. It's so funny, not really funny, kind of sad. We have enough problems without creating ones ourselves. We created this ourselves. Debt limit is currently 31.4 trillion. That's the amount of treasuries out there that the government can have. That's it. We just reached it. We can't move any further. We can't issue any more debt. The Treasury, as probably what this question pointed to, just begin using extraordinary measures. I think they put that language in there on purpose. It's meant to scare you. It's also meant to scare politicians, because when you use extraordinary, something really bad is happening. So nothing bad is happening yet, but since we're taking extraordinary measures, you better act. Again, that will help us avoid default probably maybe June or September, because we still have tax receipts to come in. So that could be a major wild card, but sometime we have to deal with this. The first thing we do is you got to look back through history, right? There've been 5 recent examples of debt limit close calls, and market behavior really has been inconsistent. The most relevant one, recent one, is 2011. Well, not the most recent one, but the most relevant one, I think, is 2011. Treasuries actually rose, which is kind of, doesn't make a lot of sense. If you're defaulting on debt, why is that instrument rising? But it did. It's flight to safety. The market sold off the S&P 500 about 17%, but it recovered all those losses within 6 months. So given all that, yes, we are worried about it. It is included in our modeling when we take a look at the overall risk picture. And while having a negative influence, because obviously a default would be bad, it is a high impact, low probability event that is not having a large influence on our modeling. I think, as always, it'll be resolved because the consequences of an actual default are just really too severe to contemplate. So I am more worried about the impact from the Fed policy mistake or earnings recession than really the debt ceiling, as the 2 former ones will have a far greater impact on portfolios.
Hi, Chris. Like in the essence of time, I think we'll just finish up with this one question. So if we didn't get to yours, Chris or I will reach out to you after the webinar is over. Just make sure we do get your questions answered. We do have a couple more, but we'll end here. With the recession rate around the corner, how can you be invested in stocks right
now? Good question. Well, first off, I'm not as certain as you are that a recession is in order. That's happening. The probabilities certainly do lean that way, but they're not 100%. Right? There is a chance that we don't hit a recession, and it has to be accounted for in any outlook. A couple of things we take into account when we're looking at those outlooks: the probabilities, and the probability is probably a recession. But what helps? One, diversification, right? Owning multiple of assets, not just putting all your eggs in one basket or putting all your eggs in equities. It's all right to have some exposure to equities as long as you have some other more defensive exposures, fixed income, some bond funds in there, maybe some gold in there. So again, the way we build portfolio is not concentrated on one asset. It's diversification is that first line of defense. And since I'm not as sure as you are, and that recession is happening, we deal in probabilities. And while that probability is high, like we stated, there is a chance we don't have one. And that has to be taken into account. So you need to have some equities in there in case that probability doesn't happen. You want some exposure to that. You don't want to be naked equities if the equity market tends to run, recession doesn't happen and markets run. And then also the big thing too is the type of recession, right? What's priced in with the markets? The market has fell a long way. So what are they pricing in? We saw that they're really pricing in that shallow recession. So if we get that, right, markets won't tend to move and equities will do fine in that environment. What they'll really be hurt in is that the recession turns out to be deep or lengthy, and we're just not seeing that in the data yet. And if we do, we may reduce equities more, but we're just not seeing it. So putting that all together, you still want to have some exposure to these risk assets because the probabilities are not 100% certain. Diversification helps you weather any downturn, and you really worry about what's already priced into the marketplace. And it might be a good time to have some equity exposure in portfolios.
So thank you so much for speaking with us all today. Really appreciate it. Just as a reminder to everyone, we do host these quarterly. You can find all of the information right on our main website, www.stonehearthcapital.com. And the next webinar is already available to register for. So if you would like to log on there and register for the next one, we would love to have you. And we hope you all have a wonderful day. Thanks so much, Chris.
Thank you. Thank you, everyone.